Let's continue on with today's Wrap the Week segment. This is our really way of recapping the market activity through the course of the week. Couple steps to this. We're going to start actually with a poll, and then we'll get some of the charts that tell the story of this week. Recent poll, we asked you the 4 top performing S&P sectors year to date through the beginning of August were energy, real estate, financials, and communication services. Which of those performs best through year end 2021? The majority answered 55%. Financials followed sort of a two-way tie between communications and energy, and then REITs sort of the laggard with only 8%. So two things that strike me about this. Number one, financials. And when I was talking to my guests, the last 2 days, Matt Tuttle on Thursday and then Samantha Leduc on Wednesday, both talking about interest rates, the rising rate environment, inflation concerns, but also the emergence of the financial sector. Really, if rates are going higher, really speaks to the strength of the cyclicals and especially the financial sector. So interesting that 55% of you picked up on that same theme that I was talking about with some of my guests there. I'm always drawn to what got the least attention because I think that usually provides a bit of a contrarian opportunity. So none of us, or 8% of us, that's not true. Only 8% of us picked the real estate sector. When I'm looking at sectors, real estate's not too bad. REITs are actually outperforming pretty well. The relative strength has tapered off. I mean, most of their gains really came in the first, 6 months of the year. June and July have been relatively flat, but it's still holding in with the markets. My thought is if the market turns defensive, which it certainly has not been doing a whole lot of, but real estates have been outperforming when the market was in go mode and could certainly re-exert itself and go higher. I'm interested going to our Wrap the Week segment here, how real estate was number 2 today. The top 3 sectors in a day when the S&P made a new all-time closing high were consumer staples, real estate, and utilities, right? And it's interesting how these sectors sort of push higher at a time when you wouldn't expect. I often tell people, don't think about what should work. I think one of the worst mistakes you can make is I'm bullish on the market, so I should own these sectors, or I'm bearish on the market, so I should not own these types of names. You're shortchanging the value of technical analysis and trend following to illustrate what actually is working. The reasons why utilities or real estate do well in an up year is something that becomes clear way later. At the time, I would focus on what's working. And again, some of the defensive stuff really working today, which is worth paying attention to. Just very quickly, a brief update on what happened today. Then we're going to look at the Wrap the Week chart, which focuses on weekly returns. Then we'll spend the rest of our time with the Mindful Investor Live chart list. The S&P today, as I mentioned, a new all-time high to finish the week strong, accelerating into the close, 4468 or so. Mid caps and small caps underperforming, with the small cap index really, pushing to the downside. Let's talk about a tale of two markets. The S&P pushing a little bit higher, again, not a ton, only 0.2%, but the small cap index going lower. Now, this is all the financials, industrials, energy, which is a little higher weight, in the small cap index pushing lower. The VIX pushing ever lower, below 16, around 1530. Interest rates actually down today, and so the 10-year yield actually came off, with the 10-year yield finishing the day around 130, and bond prices actually bouncing higher. We'll see if we have time to look at a chart of interest rates. Probably have to wait to Monday to spend enough time digging into that. Dollar weaker as well by about 0.5% on the UUP. Gold and precious metals actually working. Gold has been a tough chart, struggling recently, but you see the GLD popping higher along with silver. The rest of the commodity complex actually down today, with energy the weakest of the S&P 11 sectors. Bitcoin accelerating to the upside. We've had some choppiness after breaking above 42,000, but most cryptocurrencies in the green today, accelerating that move back to the upside. And again, when I think about charts and just very quickly decide, is it risk off or risk on? It's hard to look at the average cryptocurrency and think it's anything but risk on right now. I think Bitcoin breaking above 42,000 and remaining above that level is very important. Yesterday, you had the rotation back down to around 44,000, but really pushing back to the upside and bouncing higher here around the close, New York time. Let's continue on looking at our Wrap the Week charts. This is where we focus on the major asset classes and how they've evolved from last Friday. So we start the clock at last Friday's close. We go to where we're at today. What's interesting today is that the S&P is actually one of the best out of all of the bunch. The S&P was one of the leading asset classes when we look at the major ETFs we'll review here. Only a couple things outperformed, but most things were actually underperforming large cap stocks this week. The S&P finished the week about 0.8% higher. That's the line in black here. I'll quickly indicate the other lines In order, in red, we have bond prices using the TLT up about 0.5%. In pink, we have the NASDAQ 100 up 0.2%. Everything else was down on the week. We had, or that we'll get to here, crude oil and the US dollar both down around 0.3%. In orange, we have emerging markets down 0.4%. And the chart of emerging markets relative to developed markets, by the way, is incredibly negative, favoring developed over emerging. Emerging's really been underperforming pretty significantly for quite a while now. And then the worst performer of the group, small cap stocks, down 1%. Now, small caps still overall have had a pretty decent 2021, but it's been the last couple months where you've seen the deterioration in small cap performance. A bit of a bounce earlier this week when you saw the reemergence of the cyclical trade, the infrastructure bill, et cetera, sort of providing some upside, but really coming back off here at the end of the week. Gold, the lone asset class outperforming, but we are not looking at cryptocurrencies yet. I'll throw that in a minute. And Bitcoin's certainly the best of the bunch, but the GLD up 1%. That chart of gold, again, has been a challenging chart. It was sort of testing the moving averages, all rolled over. And then you're seeing it bounce back to the upside with, after Monday selling off, the rest of the week was actually fairly constructive for the chart of gold. Now, if we add Bitcoin into the mix, you can see that it's by far the outlier. Everything else we just talked about is down here. And you can see that the Bitcoin index that we track, the spot price essentially of Bitcoin up about 11% for the week. So it's interesting how you've seen a rotation higher. The chart of Bitcoin will go there here very quickly, and then we'll see if we can hit on gold, and then we'll go to some of the other charts. The chart of Bitcoin really has been range bound from 30 to 42,000. Breaking out of that range, I think, is significant. Key levels in my mind, looking at this chart, 44,000 is really a Fibonacci level. If you take the September low from last year, which is when Bitcoin's at 10,000, you take the high around 65,000, 38.2% of the way down is the 44,000 level, which is where we bounced this week as we accelerated and went back to new high. So I think that 44 to 42,000 level, which is this shaded area here, I think is crucial. That was the most recent test here in July before we pulled back. So I think as long as we remain above that range, Bitcoin is in pretty good, it's a pretty good uptrend. Everything else about that chart indicates more risk on than risk off to me. I see the chart is fairly constructive. Gold, on the other hand, has been a little more challenging. Looking at a chart of the GLD here, we've seen this bounce off of the lows. The GLD became oversold, undercut the lows from June, which I thought was a fairly negative pattern, now bouncing a bit. And I think going into next week, it's going to be a range bound sort of pattern from the lower end of where we've been to the upper end. But undeniably, it's making a pattern of lower highs and lower lows. And a higher low would be the key indication next week or beyond that would tell me gold is starting to stabilize. But at this point, if there is a trade that is long Bitcoin and short gold, it's been a fairly decent trade this week and really in the last couple of weeks to the last month. Let's continue on this segment looking at the Mindful Investor Live chart list. As a reminder, if you've not watched our show on Friday before this year, these are all available to you as a StockCharts member. Go to the articles tab, go to my homepage called the Mindful Investor. You can get to this list of charts called the Mindful Investor Live chart list. There's a link right at the top of my blog that has a link to this page. We'll start with the market trend model. This is a model that I've been running for years, and it's based on weekly data and exponential moving averages derived from those weekly price points. And essentially, the long-term model has been positive since early June of 2020. That remains very, very strong. The short-term model has been bullish, say, for about 3 or 4 weeks over the last 8 months. It has remained bullish pretty much every week, and that's simply looking at where we are at relative to the 5-week exponential moving average. The medium-term model, for me, medium-term trend model has been negative since May. It's threatened to turn back positive a number of times, and it is so close. And I was sending a note out to my own clients earlier today, and what I mentioned was, I designed this model to be binary. I try to take some of the wiggle room out, and so it's either bullish or bearish. There's no middle point. There's no neutral rating. It's either a thumbs up or thumbs down, and that was meant for simplicity and looking at a bunch of different asset classes and making a quick assessment about what was working and what was not. And the neutral rating sort of clouded the issue, I thought. However, if I did have a neutral rating, it most likely would have been neutral for the last month or so, because we're so close to the zero level, right? It's sort of right around that point that it really could be either way. The fact that it turned negative in May for me is more illustrating that stealth correction that we've talked about, where a lot of stocks have been pulling back. This is when all the cyclicals really started to struggle. You had a lot of leadership rotation. So I don't have a problem necessarily with the fact that it's been relatively risk off for that stretch. The daily chart looks less and less threatening. You had this foreboding pattern of breadth non-confirmation. You had the bearish momentum divergence in July, similar to what we saw in April, similar to what we saw in January. Both of those previous momentum divergences led to about a 4 to 5% pullback in stocks, pulling the S&P back to the 50-day moving average. What we have not seen is anything like that. We had a minimal pullback here in early August, but nothing like what I would normally expect given the divergence that we've had. Now, what's surprising is those were in relatively strong parts of the equity calendar. Here we're getting a bearish signal in the middle of the weakest part of the year, July into August into September. So we are not out of the woods seasonally, but I tell you, the trend continues to go higher. I see so many reasons why the market should go down, but the one thing the market is not doing is going down. I do want to point out, we talked, I believe on the show about the DeMark sequential, which is a trend exhaustion technique that I'm very familiar with. I actually registered a sell signal last Friday, which on the surface tells you we should be reverting lower, but there's a built-in signal in there where you need what's called a price flip, which is a close lower than the close 4 days ago that we have not had all week. So it didn't really validate that sell signal. I know it was on the Kramer show and I heard some buzz about it on social media. You really might have to wait for a price flip. So going into next week, that's what I would be looking for if that does happen. I think that would validate that sell signal, which is still active. You know, the breadth overall still not overwhelmingly positive, but not as negative. You know, I hesitated. I almost turned these color-coded more orange neutral color, the advanced decline line for the NYSE and for the small cap index. I did not do that. I kind of left them red, but I think it's a subjective call. It could be either or here. Probably could call them negative and feel okay about that. The reality is, though, they still have not confirmed the most recent high. So I would say to give an all clear to this market and showing a resumption of internal strength would be a close above or a move above the June highs for those cumulative advanced decline lines. We've not seen that yet, although they certainly have stopped going lower. We're seeing a handful of new lows on the New York Stock Exchange, a handful of lows on the S&P 500, but still very, very few. The challenge with that is obviously the 52-week low for most stocks is really far away from where we're at. So it's tough to indicate that as being a great indication. Maybe looking at 3-month lows or something could be a better indication. You know, I screened Wednesday for stocks making new swing highs and new swing lows using a 3-month time period. I found 66 stocks in my large cap universe, about above 10 billion or so. So that's really a mid to large cap universe. I found 66 names making new highs, 31 names making new lows. That's about a 2-to-1 ratio, which is about average. Earlier in this uptrend, it had been much more skewed. It was difficult. Very few stocks making new swing lows. We're seeing an increasing number, but still not crazy. And the last chart we'll leave it with is this one, the percent of stocks above their 50-day moving average. It's not horribly negative, right? This was at 92% in April. It was at 32% here in mid-June. It's back up to 69%. Now, that's not updated for today just yet, but overall, that's a pretty strong number. That's actually middle of the road for the uptrends that we've been in for the last year and a half or so. So that real negative divergence, where we have the stocks the index going higher, but so many stocks below their 50, that started to change as so many of the cyclical sectors have started to improve. So we're seeing the breadth conditions actually get less negative, if not starting to be supportive of this uptrend. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.